What if I told you that the place you trust most with your money is also the place that profits most from keeping you financially stuck? Not through fraud, not through anything illegal, through a system so perfectly designed, so deeply embedded in everyday life that most people never even question it. You deposit your money, they say thank you, and then they quietly put that money to work for themselves. They lend it out at 10, 15, 20% interest. They invest it. They build skyscrapers with it. And what do they give you in return? 0.01%. If you had $100,000 sitting in a standard savings account for an entire year, you'd earn about $10. $10. Meanwhile, that same bank used your money to generate thousands. This isn't a conspiracy theory. This is just how the banking system works. And by the end of this video, you're going to understand it completely. And more importantly, you're going to know exactly what to do about it. Because the game isn't rigged against you forever. You just have to learn the rules. Think about the first time you opened a bank account. You were probably young, maybe a teenager, maybe even younger. Someone told you this was the responsible thing to do. Save your money. Keep it safe. Put it in the bank. But here's what nobody explained in that moment. The second your money enters that bank account, it stops being fully yours in the way you think it is. Legally, when you deposit money in a bank, you are lending that money to the bank. You become an unsecured creditor. The bank takes your deposit and uses it however they see fit, lending it to other customers, investing it in financial markets, funding their own operations. In exchange, they promise to give it back when you ask, and they pay you a tiny amount of interest for the privilege of using your money. That interest rate has historically been so low it doesn't even keep pace with inflation. In real terms, in terms of actual purchasing power, your money in a standard bank account is losing value every single year. You're not saving, you're slowly losing. Banks aren't evil. They provide real services, keep your money accessible, and offer loans that help people buy homes and start businesses. But understanding how they make money and how that affects you is no longer optional. It's survival.
Let me show you something that'll make you genuinely angry. Not at anyone in particular, just at the situation. Right now, in most countries, a standard bank savings account pays somewhere between 0 and 0.5% interest per year. At the same time, the average credit card charges somewhere between 18 and 25% interest per year. That gap between what they pay you and what they charge you is called the spread. It is how banks generate billions of dollars in profit every single year. Here's a real number to make this concrete. If you carry a $2,000 balance on a credit card at 20% interest and only make the minimum payment each month, it will take you over 15 years to pay it off, and you'll pay nearly $3,000 in interest alone. You borrowed $2,000, you paid back $5,000 for things you probably don't even own anymore. That's not bad luck. That's not your fault for being irresponsible. That's a system specifically designed to extract maximum value from the people who can least afford it. The minimum payment isn't there to help you. It's there to keep you paying interest as long as possible. Now you know. The debt trap doesn't happen to careless people. It happens to careful people, smart people, people who thought they were being responsible. Here's how it typically starts. You get your first credit card. The limit is small, the interest rate high, but the bank frames it as an opportunity, a chance to build your credit score, have a safety net, be a responsible adult. So you use it carefully. You pay it off every month. You feel in control. Then something happens, an unexpected expense, a rough month. You can't pay the full balance, so you pay the minimum, just this once. The remaining balance starts collecting interest. Next month, the balance is a little higher. The month after, higher still. Then the bank sees you're carrying a balance and increases your limit. More credit feels like generosity, like trust, like they believe in you. What it actually is, an invitation to go deeper into the hole. More credit means more temptation to spend, more balance, more interest, more profit for the bank. And you, working harder, earning more, trying your best, are running faster on a treadmill that's quietly speeding up beneath your feet. This is not an accident. The entire system is engineered with extraordinary precision to maximize the time you spend in debt and the interest you pay while you're there. Understanding this doesn't make you a victim, it makes you dangerous, because now you can see the trap and step around it. Let's talk about the credit score. It's presented as a measure of your financial health, a report card for how well you manage money. But here's what it actually measures: how profitable you are to lenders. A high score doesn't mean you're wealthy or financially free. It means a history of borrowing and repaying that makes you an attractive customer for more lending. The system rewards borrowing and repaying over and over, not saving, not building wealth. A good credit score has real practical value. It affects your ability to rent an apartment, get a mortgage, sometimes even get a job. Don't ignore it, but don't worship it either. Don't take on debt you don't need just to build a number. The goal is financial freedom. The credit score is just a tool along the way. Now, enough about the problem. Let's talk about the solution. Start with your savings account. If your money is sitting in a standard account earning almost nothing, move it right now, today. There are accounts called high-yield savings accounts offered by online banks whose lower overhead means they pass more benefit on to you. Instead of earning 0.01%, you can earn 4 or 5% on your savings. That's not investing, that's just parking your emergency fund somewhere that actually respects your money. On a $10,000 emergency fund, the difference between a standard account and a high-yield account is $400 to $500 per year, money you were leaving on the table for no reason. This is the first and easiest move. It costs you nothing, takes maybe 30 minutes to set up, and immediately starts working in your favor. Once you understand how banks make money, you can use the same principles in reverse. Stop paying interest and start earning it. Every dollar of high-interest debt you eliminate is like a guaranteed return equal to that rate. Paying off a card charging 20% is equivalent to earning 20% risk-free, and no investment on earth reliably delivers that. This is why eliminating high-interest debt is always the first investment priority, before index funds, before anything else. Once it's gone, redirect that payment into an investment account, into assets that grow over time. You've taken money that was flowing out of your life and aimed it at your future instead. Let's talk about the biggest debt most people will ever take on: a mortgage. Buying a home is often described as the ultimate financial goal, and in the right circumstances, at the right price and time, it genuinely is a smart move. But let's be honest about what a mortgage actually is: a 30-year commitment to pay a bank an enormous amount of interest in exchange for the right to own a property. On a $300,000 mortgage at 6% over 30 years, you will pay the bank approximately $347,000 in interest alone. You borrowed $300,000 and paid back nearly $650,000. The bank made more money from your home purchase than you paid for the home itself.
This doesn't mean don't buy. Property can appreciate and you build equity, but go in with your eyes open. Every extra payment toward the principal saves a disproportionate amount in interest. Even one extra mortgage payment per year can shave years off your loan. The bank is counting on you not knowing that. Now you do. Here's everything in one clear picture. Move your savings to a high-yield account, the easiest win available right now. Eliminate high-interest consumer debt as aggressively as possible. Every month it exists, it costs you more than almost any investment could earn. Once that debt is gone, automate your investing. Set up a recurring contribution to a low-cost index fund. Pay yourself first. Make it automatic. If you have a mortgage, consider extra principal payments when you can. Small, consistent amounts dramatically reduce the total interest over the life of the loan. Use credit cards strategically or not at all. If you can't pay the full balance every month without fail, cut them up. The rewards are never worth the interest. And keep learning, because the more you understand how money works, the better equipped you are to navigate the system in your favor. The system has rules, and once you know the rules, you can use them. The same compound interest that works against you in debt works powerfully for you in investments. The same discipline banks use to extract money from you can be redirected to build wealth for you. The same tools that trap the uninformed can liberate the educated. You are not powerless in this system. You are just new to understanding it, and that's changing right now. The person who understands how banks make money and chooses to stop being their most profitable customer is the person who starts building real, lasting wealth. That person can be you. It starts with one decision, one account moved, one debt attacked, one investment automated. Small moves, consistent direction, unstoppable over time. If this video opened your eyes, share it. Financial literacy isn't just personal, it's generational. When you learn this and pass it on, you break a cycle that may have held your family back for decades. One move today, just one. That's all it takes to start.